The S&P 500 is down 27.5% for the year, and it's down 19% from the highs in August. Is it time for the next bear market rally? This is your Ready, Set, Trade Market Minute for Thursday, the 20th of October. Here's a daily chart of the S&P 500 going back several years, and you can see where this 27.5% drawdown fits in with kind of the context of this. You can see how the volatility has been increasing lately, almost what we call a broadening pattern. So broadening patterns will begin like this, and then the volatility just increases until it eventually drops like a stone. Ultimately, broadening patterns like this are bearish. So I think this is what we're starting to see playing out. Now, within that bearish context, we may get some very strong rallies inside of here. So looking at the price just overall, in terms of where it sits, we've now retraced 50% of the pandemic rally. So you can see that here with a 50% fib setup. We just retested that around the 3,500 level just last week. That was last Thursday after the CPI print. Now, I believe that there's going to be a ton of support down in this area, anywhere from 3,400 to 3,500, which should support the price at this time, especially coming down 19%. So it's almost like if you've gone this far, it's very hard to go any further with that. You can start to see these types of moves as we get near the bottom of them. They get very choppy, and then eventually we see the next bear market rally. And I think that we're starting to do that now. We're starting to see some very choppy price action. I think we're almost at an exhaustion level when it comes to the weekly chart, which is going to really stifle any further downside for right now until we reset. We've got to reset. Markets don't move forever in one direction. Now let's zoom in on this daily chart, get a little bit more detail on what's happening more recently. So you can see this choppy move we've had for the Ellioticians out here. We have 1, 2, 3, 4, 5, 6, 7 swings to the downside. That violates the pattern if that is true. But I am not an Elliotician by any stretch of the imagination. So what we have seen, though, is we've seen a very linear move start to get into a very choppy area. So range expansion moves to range contraction. So which way will this go from here? Will it go down from here into that very heavy support? And if so, I think it will be very short-lived. I think it will retest the 3,500 again and more than likely bounce back up. Now, if we see the price based on next week's earnings, and maybe that's going to be a positive catalyst for this market, if it gets above 3,800 and this descending trend line, we could get a very quick move up near the 4,000 to 4,100 area. So notice a couple of things here. First of all, we have this descending trend line, which is connecting all of the important highs really from this year, as well as the 200-day moving average in green. Those are going to be really, really difficult impediments to the upside for this to go further than that. So if this goes higher from here, it's going to probably intersect those somewhere in between 4,000 and 4,100. I think that is going to be it for then, after which we'll drop back down, and then one of two things will happen. It'll set up a lower high and drop into even further lows, or this is the third possibility and the least likely one to happen. After that higher low sets up, the price could squeeze into a higher high and get above 4,100, 4,200, and then start the recovery process. Again, I don't think that's going to happen until we fully get into capitulation, which I do not think that we've seen yet. I think we have to go much lower before a true capitulation happens. Bear markets typically last for a lot longer than 10 months, which is the age of this one right now. But the cool thing is that we can still trade through this. We have tradable swings. We have lots of market action. The market does not have to go higher in order for us to make profits. And that's the great thing about what we do when we trade options. That's it for today's Market Minute. Thanks for listening. We'll see you in the next one.